What's good, everybody? It's C from The Mask, and today you're going to learn how to create your own or find a profitable trading strategy. More accurately, you're going to learn everything that is part of a profitable strategy, so whenever you stumble across a system that you like the look of, you can go over this checklist to see if it's worth your time. This is kind of a corrective video of one of the recent uploads, which was requested by one of our mentorship members. And if you'd like to be able to request your own fully customized content or to be mentored one-on-one by me, you can join the free Discord server in the description below. Now, there are a few crucial parts to a profitable trading strategy. The main ones being the entry signal and the exit signal, both of which should tell you what you want the market to look like before and after getting into a trade. This can be a certain candlestick pattern, like an engulfing candle, a double top or double bottom chart pattern. It could even be a signal from an indicator, as long as you know when and why you are getting in and out of the market. Your entry signal also includes which time frames you look at, which assets you choose to analyze. So, as an example, if I'm using the MACD indicator from one of our previous videos, I am waiting for the market to be within a trend on the asset GBP USD, looking at the 15-minute time frame. My entry signal for a buy happens when the market finds itself trending above the 200 period moving average, while the MACD indicator line, as well as its own moving average, cross each other below the middle line. My exit signal is a firm risk to reward ratio of 1.5R, including a 20 pip stop loss and a 30 pip take profit. Next up is the execution of the strategy. A system can only be traded for a profit when trades are actually taken. That means it can have neither so many trades that you cannot keep up, nor so few that even missing a single one causes disaster. Additionally, the trader himself or herself must be able to execute the entry and exit signals whenever they are presented, regardless of fear, nervousness, anxiety, anger, or greed. Seeing as these emotions often cause mistakes in behavior, it is best to avoid strategies that bring out the worst in you as a trader. We can improve to certain extents and adjust to any strategy to quite a remarkable degree, but each person has their limits, and should you find yourself at yours still struggling with a strategy, it may simply not be cut out for you, and a change may be in order. If you are, for example, a generally anxious trader that struggles with waiting for the correct signal or timing, even after trying to work on yourself for a considerable amount of time, it may be best to adopt a different strategy that either presents more trades so you spend less time waiting, or simply one with more rules and guidelines for you to hold on to in order to combat your trading anxiety. Now, the most important part of a strategy, right after its user's ability to execute on its trades, is the edge of the system itself. An edge in trading simply means you have a statistical advantage and likelihood of generating a profit across long-term, consistent efforts. Your edge is made up of a mix of the win rate of your trades, as well as the R multiple or risk-reward ratio gained from each winning trade. It is simple to calculate whether your system should statistically generate a profit. For the simplicity of the example, we will use 100 trades, so each trade can represent a nice, even 1% of our total trades and make up the win rate in a 1-to-1 ratio. So, let's say you have a 60% win rate, meaning out of our 100 example trades, you statistically should win 60 and lose 40. If you now have a 1-to-2 risk-to-reward ratio, simply multiply them in this manner. Risk or loss to reward or profit multiplied by loss rate or profit rate. So here, you would multiply 2 reward times 60 winning trades, giving you a total of 120 R gained, minus 1 risk multiplied by 40 losing trades for a total of 80 R gained. Putting this example into percentages, let's say you risk 1% per trade and are rewarded 2% for each winner, since you have a 1-to-2 risk to reward ratio. Our reward is now 2% times 60 winning trades, meaning 120% of profit, minus 1% times 40 losing trades. So 120% of profit minus 40% of losses, equaling a total gain of 80% on your account over the course of 100 trades. If your strategy can statistically achieve about a 5 to 10% profit over 100 trades, it should account for commissions and other costs, meaning anything above that is pure profit, and you have yourself an edge in the market. Your edge obviously also factors in the necessary statistics to get these numbers for these calculations. We've created a trading journal together on the channel previously, which you can find linked in the description and at the top of your screen. Use that journal or create your own elsewhere and gather statistics through back and forward testing of your strategy, if those statistics are not publicly available somewhere else already. In order to ensure you have accurate numbers, test at least 100 trading scenarios to account for a wide range of market conditions, times of year, and news cycles. The more data you gather, the more accurate your numbers and statistics will be. So, let's recap. In order to identify a profitable trading strategy, you need to be able to check the following things off the list. Does it have a clear signal to get into and out of the market? Are you, as a trader, able to consistently execute the strategy and do exactly as it tells you? Does your strategy have a statistical edge over the market? And do you have the data to back up this assumption? If any of these three are a no, or even just a maybe, more work needs to be done in order to be able to safely assume your money is secure within this system. That's about all I have for you today, and I'll see you in the next one.